Hey guys, this video will focus on the idea of fiscal balance. Now, the fiscal balance is a useful indicator of the government's financial position. So what the fiscal balance means is it refers to a strong long-term financial position for the government's budget. Position for the government's budget where over the duration of the business cycle, so where over the business cycle all budget surpluses or budget deficits equals budget surpluses. So this means that the budget surpluses over the course of the business cycle pays off all budget deficits that the government implemented throughout the same medium term. And the business cycle is in the medium term, around 7 to 10 years usually. Now, how the government determines the fiscal balance is through a method of accrual reporting. So it uses an accrual approach. And this is different from a cash approach in that economic activity or government activity is recorded the moment they are completed. So it's recorded the moment the transaction is completed. So say for example, in a very basic note, that a store pays something on credit, although the money hasn't transferred to the other person, it is recorded as a liability on the balance for that store. And this could be broadly generalized to a government interaction. So the government, say, borrows money from overseas. Although they haven't received the money yet, this would still be recorded under this fiscal balance approach. So they use a accrual approach. So even though where there is no immediate transaction of cash, it is still recorded as a transaction under the government. So we're going to look at the two types of fiscal balance that may occur. So we have what is known as a positive fiscal balance. And although the government tries to achieve an even fiscal balance or a fiscal balance over the medium term, a positive fiscal balance means that there are an excess of government savings. And this is good because it means that there are sufficient funds available to finance further government activities without the need to borrow overseas or borrow from the private sector or to borrow from the RBA. Contrastly, we have what is known as a fiscal deficit or a fiscal deficit. And what this means is that there is an excess of deficits to surpluses. So this means the government has paid or injected more money during times of budget deficit by running large budget deficits that have not been met by relatively mediocre budget surpluses. So as a result, there should be, or this is a very bad result for the government, there should be increased interest repayments, which may compromise both our net foreign debt and the current account deficit. Okay, so the goal of fiscal balance means that over the long term or the medium term, the government budget deficits or the cost of the government budget deficits should equal budget surpluses so as to achieve the government economic goals of both inflation, full employment, equity and income distribution, external stability, and low inflation, and strong and sustainable economic growth. Okay, so that is the idea behind fiscal balance. It shows on a very superficial level that the government has achieved these underlying economic goals, and is an indicator. Again, I should note that this is an indicator of government performance.